Well, the short answer is yes. I would be on the fighting side, and I would be looking for opportunities. Admittedly, we said that we thought that also last week, so we were maybe a little early, but we still think the case holds. We think, and certainly I am in that camp, we think that the sell-off is overdone. It is now affecting basically everyone across the board. I'm not saying that there are not some companies out there or sectors that may be a little bit frothy, but now it affects anyone. So these are levels where you should dip back in. We hear a lot about peak earnings, but it's not about peak earnings. It's about peak momentum in earnings, and that's a completely different story. I think the sell-off is overdone.
Mikio, it's an interesting one with the earnings picture because so far we've seen quite encouraging results, but there is some caution in the outlook. I mean, we do get some sense that investors are worried about what happens with rising input costs for some manufacturers as well. What happens going forward when there's so many macro risks hanging out there? Do you think that is one reason we've seen this sell-off take place so rapidly?
Oh, yes, absolutely. And I think the market increasingly talked itself more and more into some worst-case scenarios, which, to, again, simplify, is basically a near-permanent state of not only rising interest rates in the U.S., but also a permanently higher level of interest rates, which changes all your discount models, et cetera, et cetera. So you can talk yourself and, get yourself into that kind of downward spiral. But at the end of the day, there comes a moment where you take a step back, you look at the balance sheets in the U.S. companies, you look at the actual macro outlook, and you still sufficient strength. Now, 80% of the S&P companies have beat expectations, and earnings growth is about 20% plus. On an EPS level, yes, that may be not as strong going forward, or it will certainly not be as strong going forward, but margins are not, are still relatively modest, so there is still an upside in terms of direction, and that's all you need. In terms of interest rates, if you look historically at, 40, 50, 60 years, yes, when you have a big increase in real interest rates, it is a concern, but usually that still goes with positive returns on the stock market. The level of the return varies, but the direction is also clear. And in the cases where it does lead to a recession, which is not always the case, it has to do a lot with, it needs time. It needs 1 or 2 years until the higher rates eat into credit quality and all this sort of stuff. We're not there yet.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.